Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by Alan Higgins, plus a very special guest, but more on that in a moment. Each week on the podcast, we look at the three things investors need to know, which might be for the week ahead, but we also look at longer term trends and we read the research so you don't have to. But before we get to our special guest and what we're going to be talking about this week, Alan, a few things to catch up on. Now, first of all, I'm thinking back to, we recorded an episode with our UK equity expert, Richard Way, back on the 21st of November, if anyone wants to listen to that again. We talked about Santa rallies, and there was a little bit of a debate between you and Richard about January and what happened to markets in January. And you said that January was actually pretty good, if I remember correctly, for US markets. Now,
correct.
We've had something through from Howard Sparks. Regulars to Need to Know will know Howard Sparks. He's our US equity expert. Now, what was the sort of data that he sent you through about January in the US?
So I should say hello, Sarah, and everyone listening to. So yeah, he found a nice little factoid, which is the opening day can be Jan 2, can be Jan 3, depending on what's happening. But the opening day is the most volatile day of the year. So don't be surprised. You get back here in January and you say, oh my, what's going on? But to the nice part about it is it tends to be volatile to the upside. So the median return is basically up just under 1%, 0.8% on the day. But it can be volatile. It can be an up 2% day. I like to think of it, Sarah. Remember our old friend at Sun Alliance? He gets his he gets his allowance of putting 200 million into the market. He thinks, oh, it's the first day, I'll put some in.
Rather than leave it to the end of the year like I normally do, I'll put some in on the 2nd of Jan.
Yeah, so something like that. Who knows the reasons why? But look, it's nothing serious. But just to reiterate, at least for the US stock market, January is traditionally a good month. But Richard's quite right. The UK stock market is actually, on average, has been slightly down over the last 50 years. But these seasonal effects, the more time goes on, the more they kind of dissipate and the less attention people pay to them, to be honest, Sarah.
Okay, well, we'll be watching for that then, whether it's, I'm not sure whether it's going to be the 2nd or the 3rd of January. I suspect the 2nd of January could be the most volatile day of the year for US markets. We'll keep an eye on that. And then there was something else, because it sort of ties into what our Need to Know is this week, but I don't want to spoil that one. But we were also talking about, I think it was last week actually, about Japan and how Japan was slightly under the radar. And you wanted to say something about Japanese, Bank of Japan, first of all, because we've got, obviously we don't cover the data so much now because we know that people are not listening to the podcast the day it comes out. So we weren't planning on talking about what the ECB and the Fed and the Bank of England are doing, because they've obviously got meetings this week. But we have got the Bank of Japan, haven't we? And that was the one, certainly last time when we had this sort of tranche of central bank meetings, that you were kind of saying was the one to watch because it was the one that could potentially surprise. Thoughts on that as we head towards the end of the year? Because we had a big surprise. We had a bit of a surprise from this time last year, didn't we?
We did, and you're right, Sarah. So, yes, there's been comments from central bank officials, comments along the lines of, well, a rate rise can be good for certain sectors of the economy, that sort of thing, and kind of preparing us, because Japan is the last place, really, that you can find negative rates, very slightly negative, and it seems they're going away. Yeah, there's been a certain Japanese stocks have done well this year, as we know, but one sector's done really well, which is Japanese banks. So if I said to you, Sarah, at the beginning of last year, and I said, you know what, 2023, Japanese banks are the place to be, what would you have said to me?
I would have been incredulous, Alan.
Exactly. Well, in local currency terms, at least, up 40%.
Really?
Japanese banks, yeah. And look, this is not all about Coutts. Coutts has a full Japanese equity, but it's obviously small in comparison with other markets. But it just goes to show there are more than one ways of winning in the market, and it's not all about growth investing in the Magnificent Seven. In Japan, the value style is working well, and that's actually, to be fair to us, that's what we are doing right now, the value style. And obviously banks just like virtually everywhere in the world, are very, very cheap. But it just goes to show, and I think it leads nicely into what we're going to say, because we're going to talk about surprises. But before I hand back to you, Sarah, let me introduce the guest for today.
Yeah,
so I'm very pleased to. Sorry, Sarah, you can tell that this is not planned, right?
I was just going to say, Alan, over to you. You've got someone very exciting to introduce.
So I'm very pleased to introduce Fahad Kamal, the new Coutts CIO. Welcome, Fahad.
It's an absolute pleasure, Alan. Thank you. And a very unexpected one, I might say, talking about surprises of the year.
Yeah, well, I'm not surprised at all. And this is not about me, but just a little bit about me. I'm going to be around for a fair bit longer yet, and maybe even a lot longer doing this sort of thing. So don't worry about me. One colleague we know well, Fahad, basically said, and this is kind of a compliment, but kind of a bit of a dig, because you know what she's like. We will send this podcast to her. She said, "You're a younger version of me." What is that? What's going on there, Fahad?
Well, I wish I had as much hair as you, Alan. That's all I can say about that.
Well, thank you, Fahad. I think what she's getting at, in all seriousness, is that we both have a share of when, in terms of investment style, we both like to earn risk premium, don't we? We both basically look at the markets, whether it be equities, high yield, and even within hedge funds, merger arbitrage, where there's a risk premium. We have the mindset, let's go and earn it with appropriate due diligence, don't we? That's, I think, where she's coming from.
Absolutely. I mean, that is effectively the investment process in a way, right? It is to, and if I may summarize it to a very pithy phrase, it is to to be well rewarded for the risk you're taking, to make sure you're taking risk, but that risk has a reasonably high probability of success and is obviously couched within risk parameters that are sensible. And that really, in a nutshell, is the elevator pitch of the investment process.
Yeah, I completely agree. The right way to do things. Sarah, why don't you ask some questions?
Well, I was going to, for those that perhaps that listening to need to know that don't know you, Fahad, that maybe haven't seen you perhaps in talking on TV about investments, and just give us a little bit of a short summary of your career, where you were, what's brought you to Coutts, and just where people might know you from.
Sure, Sarah. You don't have to ask me twice to talk about myself, but yes. So look, immediately prior to Coutts, I've been here for less than a month, so this is a very new appointment. Prior to that, I was the chief investment officer at Kleinwort Hambros, which is not a dissimilar bank. We are an old private bank based in the UK with a relatively similar mix of clients. We weren't as big, but sizable at about £12 billion under management. And Alan and I have known each other over the years, running into each other at conferences and things of that nature. And it's true, I've always enjoyed speaking with him, and it's a singular pleasure and honor to be on his podcast.
And you've only been actually.
Hold on, I've got to jump in there. Sarah's, don't forget Sarah's podcast. we have honor of being on Sarah's podcast.
Well corrected. Thank you.
I think we split it 50-50, although I do think you do most of the heavy lifting, Alan, to be fair.
That's kind.
So Fahad, I mean, you've been with Coutts a relatively short time. First impressions of that time in 440 Strand.
Oh, well, I mean, obviously the history is just amazing. I mean, having come from a relatively old English bank, still, I mean, nothing that really doesn't hold a candle to the history and the grandeur of Coutts, the name, the brand, the people who have been clients in the past. In my tour, I had the pleasure of seeing Charles Darwin's signature, amongst others. I mean, that is the kind of thing that just can't be bought. It is a genuine strategic differentiator, this incredible history that we've got. Also very impressed by the investment process, and I mean that the engine that exists here is sensible, it's risk appropriate, and it will deliver over the long run, as it has over the last 10 years. There's no question about that. Primarily for the reasons that Alan already touched on, there is a sensible exploitation of risk premium as it exists within a sensible risk framework, and that is And that really, is far more important than any single personality, is that we have a process that is repeatable, implementable, executable, and one that has a high probability of success over time.
Brilliant. Well, we look forward to getting to know you a little bit better on Need to Know, Fahad. So the rules are, for those of you that haven't listened to Need to Know before, wherever you've been, if you haven't been listening to Need to Know, we look at three things. And because we have a guest on, that means our guest gets to choose two things and Alan gets to choose one thing. Slightly different. It's that time of the year when we're kind of thinking to next year, and you'll see endless predictions of what people think is going to happen in 2024. But something that Alan and I have been talking about doing quite a lot is in homage to Byron Ween, who passed away earlier this year. He always used to do, I think, am I right in thinking, Alan, he did 10 surprises for the coming year?
He did do 10, remarkably. Some of them were somewhat micro, but still, remarkably intuitive and creative. And I worked with him briefly at Morgan Stanley, and this is a great homage. Fahad and I will try and do him justice, but there'll be pale imitations, but we'll do our best, won't we, Fahad?
Yeah, look, the great Byron Ween, I've had the pleasure of sitting in a presentation that he gave about his 10 surprises probably around 6 or 7 years ago. And even then, I mean, he was obviously an elderly gentleman, but full of, pep and gusto. And yes, the homage is appropriate in the year that he's passed, and long may his 10 surprises live on.
And so just to sort of explain a little bit what we mean by surprises, these are not predictions as such. So what Byron Ween was doing, if correct me if I'm wrong, Alan, was he was looking at things that perhaps he thought were more likely to happen than markets were pricing in, or experts were kind of expecting to happen. So he's not saying these are definitely going to happen. He's just saying the probability is slightly higher than maybe expectations are. Is that a fair summary?
It's fair. I would even go as far as saying, especially my one, you'll hear, is actually quite unlikely to happen. But let's say when you come to my one, probably if you ask the average economist, people will put a probability of 1 or 2% of my one happening. Whereas Fahad and I might say, well, that may be a 10 to 20% chance of this happening. It's that kind of thing. It's kind of a misunderstanding, overconfidence. Well, we mentioned Japanese banks. I would have never guessed Japanese banks would return 40%. But these sort of things happen. So that's the way to look at it. Is mispricing. Would you add anything, Fahad?
Well, the only 100% chance of certainty that we have in next year is that we will be surprised by things, by events as they come, and exactly that. I mean, look, markets obviously have a base case for how the next year will unfold. There are forecasts, etc. But there are many things that, as Alan said, that are probably mispriced, underpriced, underappreciated, and we'd like to tease those out. We don't expect they're going to happen. In fact, probably we expect they won't happen. But nonetheless, they are still being underappreciated in one way or the other.
Okay, all right then. Well, Fahad, you've got two big surprises potentially for 2024. What's your first one?
The first one, Sarah, is that we might well see a big global equity rally next year. Now, obviously, here we are towards the end of 2023. And the global equity market has been a massive upside surprise this year, obviously led by the US, particularly by the tech sector. But nonetheless, if you look at the global equity complex, it's not just the US, Japan, as we've discussed as well, is up well into the double-digit territory. And that has been a big surprise. Now, most are not expecting a repeat performance next year, but we think actually that it's possible, it's more than possible. The reasons are manifold. One is obviously the environment may well be more supportive than we expect, right? We may well find ourselves with with the unicorn of a soft landing, actually appearing. Inflation starts to get more under control. We already see that happening. As a result, the strictures that have been applied to global economies via monetary policy get easier. And they don't become easier in the face of a recession. We just actually find ourselves muddling along, chugging along Earnings remain relatively upbeat for corporations, and we end up next year with another 20% year. Now, just to give you some historical context on that, since 1970, 53 years for those who are counting, the S&P 500 has returned on average about 11% a year. Now, interestingly, off that 11% of the year, that 11% number itself quite rarely occurs. One in 5 times, about 20%, you get a negative return. But over half the time, you get a return that's above 15%, and a third of the time, 36% actually, you get a return that's above 20%. The point is, you're much more likely to overshoot than you are to get to the average, and in some cases, in some years, you will undershoot quite massively. I think that there's enough positivity and enough of a chance of a soft landing that we may well see another big overshoot next year, which would obviously be more than welcome news to all of our clients and to us.
Okay. And we're saying that's a surprise. So what are expectations then going into 2024? What's the consensus then, which we're kind of slightly pushing against?
The consensus is closer to that average number, right? The average that very rarely happens. But that's sort of what most consensus, almost at the end of every year about the next year coming, centers around. Usually people see about an 8 or 9% upside in the global equity market, which is about the long run average, which is where the consensus is right now as well. We may, here we think, Alan and I probably are agreed that actually a doubling of that is more than possible and being underappreciated. And I would expect that rather than a big sell-off into next year.
And what would we need to have in place for that to happen, for that big surprise to happen? Presumably no US recession.
Of course. I mean, it really would be the materialization of a soft landing, which effectively is that we do have inflation that inevitably comes back towards its 2% target. We have unemployment that stays relatively low, and we have growth that chugs along into positive territory without falling into recession. All of that, should it occur, we'll probably see another big upside year for equities.
Thoughts on that, Alan, from you?
Yeah, I think that's so right. And the most logical response, actually, when asked, what's your forecast for the market next year? Is, as Fahad said, you either say down 7% or something, or you say up 15 to 20. None of this up 8, 9, 10. I would add that what I've seen, there's still quite a lot of bears out there, Fahad, the likes of Morgan Stanley and JP Morgan in particular, kind of leading the charge on the bearish front. But so this is one of those ones, I think it's a great example of a surprise where actually it's a higher probability than certainly my one coming up. It should be put right up there. But yeah, probably after a really good year for US stocks this year, it would be a big surprise to see 15 to 20.
And look, I'll just add to that the fact that there are large investment houses out there that are more bearish is in itself probably it leaves more room for upside than anything else. I mean, at the beginning of this year, some of those houses were very negative on what was likely to unfold this year, and they've obviously been proven wrong. And it's exactly in those times where you've got a lot of contrarian upside, where you have a lot of negativity about what's happening next year. Not that that's at all the base case, but nonetheless, the fact that there are bears out there, if anything, is a good omen for our upside surprise.
Okay, so that's our first one then. So we're saying then that we potentially could see a rally in global equities of sort of 15% or more. We're not saying that's going to happen. We're saying that maybe that is more likely than perhaps some people think at the moment. Okay, what's your second one then, Fahad?
The second one for me is that it sort of leads on from what we said. This might be a more positive year for global risk assets, and one of them is sterling. Sterling tends to do quite well, and the cable pair tends to do quite well when you've got a global risk on backdrop. The dollar tends to get weaker, the sterling tends to get stronger, and that's barring keeping all else equal, that tends to be the relationship. Now, a lot of that is going to ultimately depend on relative monetary policy, right? As of this moment where we sit, the expectations are there's going to be somewhere around 4 or 5 interest rates cuts by the Fed, and fewer interest rate cuts by the Bank of England. Ironically, the Bank of England was the very first central bank to start raising rates in this cycle. It's likely to be the last one to start cutting them in this cycle as well. Because the UK just has a much more structural inflation problem and a much more challenging pathway to get inflation down, partly because of a very structural labor supply shortage that is leading to higher services, wages, etc. As a result of all of that, long story short, is that we may well see the Bank of England be tighter and the Fed be looser, and all else being equal, that tends to be supportive of sterling. So that's one side. The second thing about that is that sterling is also quite undervalued. So if you look at any purchasing power parity model or any kind of relative fundamental valuation of sterling, you would expect it to be trading closer to 135, 140. Here we are at about 125. So, and by the way, these are very theoretical models. Their application in any real life scenario is limited, but nonetheless, they are a North Star, and sterling is undervalued. And one avenue that undervaluation might be unlocked is a huge surprise, which is stability in the UK's political environment. Can you imagine that? We are likely to have an election in this year. It may well go into 2025. I doubt it. It'll probably be this year. And it may well result in a very stable government with a strong mandate to govern, something we haven't had in a long time. The winner of that election is likely to be a centrist on either side, whether it's from the Labour's or from the Tory party, with a new mandate. And that stability may well be one potential reason why investors get more bullish on sterling, in addition to the rate differentials that we discussed earlier. But it would be an upside surprise, but certainly not impossible.
And certainly the other side of that is we've definitely got elections in the US next year, and obviously part of that trade is stability in the US, more risk on, weaker dollar. I mean, I know we don't like making predictions on this, and I know Alan doesn't like making predictions, definitely, but sort of thoughts on then how a US election, how that might pan out and how that would impact currencies as well.
Well, look, I mean, you're right. I mean, we don't talk about geopolitics much when it comes to long-term assets because it tends not to be a very good indicator. It's a red herring, if anything. Having said that, the US election in November is likely to be more contentious and spicier than usual, and it may well result in the election of a new president that who could possibly be quite disruptive. So, to the degree that has implications for the long-term fiscal saliency of the US, or even its general role as the world's final arbiter of sense and a Pax Americana. I mean, all of that stuff does come into some kind of play. I would say that nonetheless, that's still marginal. But surely it's the opposite of what might happen in the UK election, where we end up taking the road of more stability and the US takes one of less stability.
And I know, Alan, we've discussed before what happened with the last time when I mean, we're not making political judgments here. When Trump won, I think there was an expectation that there would be this kind of massive impact on markets, which actually there wasn't at all, was there?
There wasn't. As a reminder, what happened on the day, it was a surprise. US futures, US stocks were essentially down 5%. At the end of the day, up 1%. At the end of the day, when you invest in the stock market, it's about corporations, not presidents. Now, they can influence, especially through tax rates, etc. So, yes. But just come back to Fahad, your point on sterling strength. Would that also be generalized dollar weakness you're looking at there as a surprise? Because we haven't had it for quite a while, any significant dollar weakness. And would that be a component of the surprise as well to edge sterling dollar up?
Of course. Look, as always, currencies are pairs, aren't they? And there'll be two sides of that equation. And surely, in an environment, as we discussed, of a soft landing, of a relatively benign economic and inflationary environment, one in which the fundamentals become more underpinned and corporations are doing okay, you can absolutely see an environment where the dollar is less bid because it's safe haven premium is less required.
Okay, all right then.
Yep.
Well, that's your second one then. So we're saying then potentially maybe sort of people are not expecting perhaps stronger sterling next year off the back of perhaps greater political stability in the UK. We'll wait and see for that one. Okay, last one then. Back to you, Alan. What's your big surprise? And I think this is the one that's got the lowest probability, possibly.
Possibly. We may have to wait till the end of the year. So what I'm going to talk about is very low inflation. How can that happen? So by very low inflation, I mean significantly below 2%. And we've talked about it a lot. But, I'll give the reasons why. But Fahad, you jump in.
Oh, I was just going to say, are you raising the specter of the D word?
No, not quite deflation. No, but I will take you back to a period, Fahad. You remember the period? So when did we last have pretty low inflation? Of course, when we went through COVID, but actually 3 years, 2014 to 2016. Okay, I'll give you the numbers. They're quite surprising. US inflation for those 3 years, 1% average. UK inflation. I love to put Sarah to the test. Okay. Sarah, okay. UK inflation. Okay, if US inflation was 1% average, UK being very inflationary, it must be more, right?
I would 3%.
No, 0.8.
Really?
I caught you again, Sarah.
You did.
Don't fall for them. You shouldn't fall for them. So UK inflation can be lower than the US. Now, okay, so evidence inflation can be substantially lower. Now, what's driving inflation lower? We got some theories. We've talked about it before. Money supply negative in the US and the UK in particular. We're seeing wages come off and the impact of rate increases. So there's some fundamentals behind this lower inflation. But if we go back to that period, when we had 3 years of basically 1% inflation in the UK and US, what was happening? You do need a weaker oil price because that kind of kicks things off. And I'm talking about, headline here. So what's going to happen to oil? Well, frankly, no one knows. But could oil come off 10 to 20%? Of course it could. Oil is that kind of commodity. So we need that. But I think it's a genuine surprise because literally no one is expecting, say, 1.5% inflation in the UK or the US. No one that I've read yet. And I will read some more. If anyone's seen a forecaster out there saying that, then let us know. So it would be surprised. Now, it wouldn't be, a podcast with me if I didn't reference equities over that period. So very low inflation for 3 years. Do you want to know what equities did? I'm sure Fahad can remember. It was a good period, Fahad, you remember. What is again surprising is UK equities did quite well. So US equities, 36% over those 3 years, 11% compound. It was a rocky period. And it goes back to Fahad's point. The path over those 3 years was rocky. But over 3 years, you earned 36%. UK equities are a respectable 31% over that period. So look, close to so Fahad, not deflation or disinflation, but close to zero inflation. Yeah, stock markets absolutely can power through. Admittedly, there were some rocky corrections along the way. So yeah, that's my surprise. My Byron Ween homage surprise is that towards the end of the year, could we see, say, a 1.5% handle, something like that in the US, a 1.5% handle in the UK? Imagine what a surprise would that be. Fahad, what do you think it would do to markets if we had that kind of inflation profile?
Well, look, the devil's in the details, right? I mean, if it's really a mechanical output as a result of used car prices coming down and sort of the rent part of the inflationary basket, coming off quite meaningfully as we expect, but yet everything else seems to be holding together. I think the equities will have a new S&P 500 all-time high, and the sky's the limit. If, however, that inflation is being driven much lower by recessionary factors, effectively, right? By coming off of wages, etc., then it's different, and we'll see. But between those two, I think that the former rather, is more likely. Is a recession possible? Of course, but it's not. It's not my base case. I do think actually that inflation will get lower, and it will do so for the right reasons.
True. Yeah, I think go lower. I think most economists, can't see inflation going below 2.5%. Outside a recession. That's a good point, Fahad, to bring in recession, because obviously a deep recession could take inflation much lower. But I think this kind of inflation profile, if we get there, forget your 15% return on stock market. It'll be a 30% year. It really would be a strong year. And Sarah, you better get your disclaimers out, because Fahad and I are making some bold claims.
You are making some bold claims.
But these are my surprises. I did want to put one in about Bitcoin, but maybe I'll do that next week in our last one. I'll talk a bit about Bitcoin. I was going to say something along the lines of BlackRock finally get approval for the Bitcoin ETF, and then the price crashes. That would be neat. But leave that for another time.
Yeah, because I did actually notice a former guest of Need to Know, James, whose surname escapes me for a moment.
James Butterfield.
Butterfield was being quoted in the FT talking about crypto and ETFs and things. So yeah, maybe we should talk about that next week, which I'm thinking is probably going to be our last Need to Know of 2023.
Yeah, definitely.
Because we're all going to disappear off and have a nice, well-earned break.
Speaking of crypto, who would have thought, that was another massive surprise of this year. I mean, if I told you that we'd hit 44,000 in December, you would have locked me up somewhere.
Yeah. Quite.
That's a very good point. Well, thank you very much to Fahad and Alan. So just to summarize then, make a mental note of these, and we'll revisit these at the end of next year. We've got the three surprises in homage to Byron Wee. We're not saying these are definitely going to happen. We're just saying that maybe the probability of these things happening is slightly higher than perhaps some analysts might think. We've got a global equity rally of 15% or more. We've got stronger sterling versus weaker dollar. And we've got global inflation to fall well below 2%. Interesting. All right, then. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. As I said, thank you very much, Fahad and Alan, for joining me today. Don't forget.
My pleasure. Thank you.
As I always say, to check out the podcast page on Coutts.com and subscribe to Need to Know wherever you get your podcasts. Until the next Need to Know, which is, I think, next week will probably be our last one of the year. Bye for now.